G'day and welcome to this week's video. My name is Robert Gowdy and I'm a financial advisor at Consortium Private Wealth. This week we're going to have a look at lifestyle investing and also how that relates to understanding your investment timelines. So really important area, and I think there's a few flaws in life cycle investing, which if we have a look at the screen here, and this is a chart from Q Super, which is a big industry government superannuation fund up in Queensland. And you can see here that on the right hand side we have medium to high risk portfolios. So there's a bigger allocation to shares and property and growth investments. And as we get older, we can see that the swing from growth investments is migrating back to more conservative investments such as cash, term deposits, fixed interest and the like. So as we get older, and we can see as we move down the line here of these different portfolios, we can see that the expectation of returns is reducing, and you can see once we get over to 58 that the amount of money that's invested in that growth area, you can see here the arrow, it's the risk or the volatility that we'll see from the market movements is extremely low. Now, I personally think this is absolutely flawed, and to prove this point, let's have a quick look at average life expectancy from birth in the first place, and then we'll look at a couple of other timelines. So life expectancy from birth, we can see for a female approaching 85, and for a male we're sort of 80 and a bit. But if you make it to age 65, the figures look a lot different. So a male that makes it to age 65, you get to 65, every chance you're going to have nearly another 20 years to run, which takes you through to 85. And for a lady at 65, there's every chance you're going to make it through to 87, 88. And then if you make it to age 85, obviously the average, the timeline from there is obviously you've beaten all the odds, you've beaten all the people from birth to get to that age. The average life expectancy at age 85 for a male is 6.2, so it takes you in to your 90s and well into the 90s for a lady. So the key points I'm trying to make here that I think life cycle investing has some serious flaws. Your retirement age is not your investment time frame, which a lot of people sync the two together, that, well, I'm about to retire at 60 or 65, I've now got to be very conservative, and that's what some of the major super funds are really suggesting that is exactly what should happen. So it's not your investment time frame. Your life expectancy is your investment time frame. So someone that gets to age 65 and retires, there's every chance that you're going to be about for 20 plus years, and that is your investment time frame, which means you can still be growth orientated. Now, if you become too conservative, your money's not going to last and it's going to run out quick. And as we can also see from obviously the longer that you live, the longer you're going to live. So by all means retire on the terms that suit you, but you can physically retire, but you've got to make sure that you keep your money working and don't retire your money as well. Thanks for listening. Give us a thumbs up and subscribe to the YouTube channel, that'd be great. There's a whole heap of resources down below, such as free courses that may not suit yourself, but they may suit families, some good educational stuff there. So check that out, and we'll catch you next week. Thanks for listening.